Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So we're going to start off with the market regime because I think that's the most important factor out there. Then we'll review the downtrends in SPY and QQQ and show that small caps are actually holding up a little bit better here in January, February, and into early March. And then we'll look at some breakouts in steel, defense, and agribusiness. So I'm going to start off with the broad market environment. Are we in a bull market or are we in a bear market? And I am working under the assumption that we're in a bear market. And it has nothing to do with the geopolitical events that are happening out there. It has nothing to do with the Fed. Maybe those things are affecting stocks and price action. But I'm working with a breadth model that weighs the bulk of the evidence. It weighs the evidence. And when the weight of the evidence is bearish, I turn bearish. And I'm talking technical evidence, breadth indicators like highs and lows, like advances and declines, like percentage of stocks above the 200-day moving average. And so I've got a breadth model that's got 5 inputs. And you can see here over on the right, it is at -1. And that means 3 of the inputs are bearish and 2 of the inputs are bullish. So it's negative. We got a little whipsaw there in January, but right now it's clearly bearish. And if we look at the chart at the top here, we've got the 5-day moving average for the S&P 500 in green and the 200-day in red. And you can see we got a little whipsaw, but now it is below. And what matters is, what is the situation right now? And right now the situation is the 5 days below the 200-day. The composite breadth model is bearish. And then if you look down at the bottom window here, you can see only 37.4% of stocks are above the 200-day, which means 62.6% are below. So far more stocks are below. And so that suggests that the weight of the evidence is bearish for stocks, and that means there's a headwind. If you're trying to pick stocks to go up, there's a headwind working against you, and it's going to be harder to pick stocks, which means you probably should be raising cash and taking smaller bets, if you will. Now, another indicator group that I use is the percentage of stocks above the 200-day. You can see for the S&P 500, for the mid-cap 400, small-cap 600, and NASDAQ 100. And mid-caps and small-caps, fewer than 35% of stocks are above the 200-day, and the NASDAQ 100, fewer than 30%. Maybe it's oversold, but clearly there are more stocks in downtrends and uptrends, and there's the S&P 500. And we've had deterioration since basically the summer, but it didn't become a concern until January when we started breaching the 40% levels in all four actually in January. And so that's why we're saying that there's a big headwind out there for the average stock. So I'm going to keep an open mind. Anything is possible. If we look at this SPY chart, we can see we've just had a massive move. And the last decent correction that we had was in September and October of 2020. The composite breadth model did not turn bearish during this correction, by the way. We had this little pullback here, and composite breadth model didn't turn bearish either, and you broke out. But now we've had this big move down in January, a little bounce in February, and another move lower into late February. And so we've got some lower highs and lower lows working. Now, there is a chance that this is a falling wedge, and it's correcting after this big move. So maybe it's a big falling wedge correction. But we've seen a bounce, an oversold bounce, but we haven't seen that follow-through surge and the break back above the 200-day to suggest, we're getting more than bottom picking out there. We need to see some buying pressure after we've had a bounce. That's kind of like the follow-through days or breakout, if you will, and we need to see a breadth surge. And right now, I haven't seen that yet, and I think this is a downtrend. The breadth model is bearish, and so that's why I am bearish. Now, if we look at QQQ, we can see a similar pattern at work, which is unsurprising because it is a large cap dominated ETF, large cap techs. But a similar situation, it had the correction with the big triangle in September and October and the big breakout in November 2020. And, it had some pullbacks along the way, normal pullbacks. But this one broke the camel's back, if you will, with that big move down below the 200-day, failed at the 200-day and moved lower. And so, yeah, maybe it's a wedge, but I've yet to see any follow through to this big oversold bounce that we had. We had a big oversold bounce, but couldn't follow through and fell. So now I want to see, in particular, I want to see a breakout in the S&P 500 because that's really the index that is driving the market. If you can get the S&P 500 back above its 200-day, then we can talk. But as long as the S&P 500 is below its 200-day, the weight of the evidence is clearly bearish. And then if we look at small caps, I'm going to use IJR because it's a little bit better than IWM, I think a little bit less weak, if you will. And you can see here that, we had some breakouts that failed. We move into this consolidation and it triangulates, and then we get a breakout to a new high, but it fails. And then we move to a lower low here. We broke below this low. Everything broke down in January. Now, the thing about small caps is you just saw SPY and QQQ, and they had these lower lows from January to February. Well, IJR and MDY, I believe, have higher lows. So they're showing a little bit of relative strength. So if they can get a breakout here, so we're seeing small caps showing some relative strength. And if they can get a breakout here, that's going to be bullish. But again, I'm not that excited because the bulk of the evidence remains bearish for the stock market. So I wouldn't be taking bullish signals until we see a breadth thrust and some improvement in the composite breadth model. Now, you may have noticed that I am showing line charts, and because when things get extra volatile, I like to turn to line charts and take a step back and get some perspective and see what's going on. And I posted an article on XME on February 11th, and you can see that at Stock Charts. I posted it under Arch Charts. There it is, February 11th. Because it was showing some relative and absolute strength. And there it is. It's in this big consolidation, and it was challenging resistance. I think it had just closed above, and it was poised to break out. And you can see the relative breakout there. And the trend did whipsaw, and the reason it whipsaw, this is the trend composite indicator, by the way, is because we were in a trading range. We weren't trending. And so if we go back to the chart here, we can see it was just a massive consolidation, and now we have broken out and we're accelerating after the breakout. We had a little bit of a dip, but look at that acceleration after the breakout. So this is a big breakout, and steel is taking the lead, which leads me to my next chart, which is going to come from Stock Charts ACP. Did a resize for you there, but this is SLX, and it is also getting a big breakout. You can see that it was really lagging here. And I could put that trend line there. And you can see that you had this massive advance. You went from the 30s to the mid 60s. You pretty much doubled, more than doubled, and then corrected and really lagging here in October and November and December. But then got the breakout there in January, February, and had a little pullback and are surging again. And at the bottom, we've got the trend composite indicator turning bullish. And what this indicator does is it aggregates signals in 5 trend following indicators. So if I go over here to the left here and I click on the settings, you can see those trend following indicators and the settings. But I set most of them, all of them, at 125 days because I'm looking to capture a trend that is in that 4 to 6 month range. And if you're interested in the trend composite, there's a plugin link in the bottom right, and you just click on those plugins, and I'll take away the annotations. And there you can see all the plugins available. TrendInvestorPro.com Indicator Edge plugin. So check that out if you'd like to know more. about this trend following indicator and the others. But the point is, we got a bullish signal a few days ago, and we're getting a follow-through breakout. So money is clearly moving into steel. So here's the main analysis page at trendinvestorpro.com. And you can see at the top here, I've got a market regime link because I update the market regime every week with a bunch of breadth charts. We also have an ETF signal table that tracks the trend composite signals in 276 ETFs. And there's some free analysis here if you're interested. That's the main analysis page here at trendinvestorpro.com. So every week I put out a long commentary with lots of ETF charts. This week we're looking at retail trending lower, finance looking vulnerable, and breakouts in defense, uranium, and steel. And I also have a series on the trend composite. There's the weekend video. And I've got a trend composite series where I am quantifying signals in the trend composite and showing you how it works in a portfolio. So check out trendinvestorpro.com if you'd like to know more. So we're also seeing money move into defense, and defense was lagging, just like steel. Defense was lagging in the summer and into the fall, into November, December. So this is the PPA, the Invesco Aerospace and Defense ETF. But then we started seeing higher lows. So higher lows in December and January and February. And meanwhile, SPY and QQQ were making those lower lows. And so basically we had a massive correction underway, and you can see that we got this big breakout and hit a new high or just touched a new high. But I would expect this one to continue higher because this is a big advance. This is a long correction. We've had a lot of long corrections because the preceding advance was so big. But now we've got a breakout that signals a continuation higher, and that argues for higher prices in PPA. And there are three defensive ETFs out there, PPA, XAR, and ITA. The other one I like is ITA, and because it had a split that is not adjusted, I have to use normal ITA there. So we can see a similar pattern, a big advance, and then you had this correction or long decline, and then started seeing relative strength here. As the market moved lower, defense started moving higher, and then look at that breakout. So I would expect a further gains and new highs out of ITA based on this breakout. And real quick, I just want to highlight the agribusiness ETF, MOO, and it is breaking out to a new high. It had a false breakout like everything else in October, but it fell back into its consolidation, held these lows here, and is breaking out to a new high today. So if you're hitting a new high and you're above the 200-day, you're leading and you're in an uptrend. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.